Hi everyone. Today, we are going to review the basics of the financial market. This will be an easy and quick overview, so let's get started. First, what is a financial market? Financial markets are platforms or networks where people and institutions buy, sell, and trade financial assets. These assets include things like stocks, bonds, currencies, and even complex products like derivatives. Why financial markets matter? Now, let's talk about the main functions of financial markets. First function is capital allocation, meaning they direct money to businesses and projects that need it most. Second is price discovery. Markets help decide the fair price of financial assets based on supply and demand. And third function is liquidity provision, meaning they make it easy for investors to buy or sell assets quickly. Fourth function is risk management. Through special tools like derivatives, markets help investors protect themselves against risks. And last function of financial market is facilitation of trade and investment. They allow easier trading, both within a country and internationally. Types of financial markets. There are different types of financial markets, each serving a specific purpose. First is capital markets. These are for long-term investments like stocks and bonds. They help businesses raise money. Second is money markets. These deal with short-term debt, things that mature in a year or less, like treasury bills and certificates of deposit. And third is foreign exchange markets, also known as Forex. This is where currencies are traded. It sets the exchange rates between different currencies. Fourth is derivatives markets. Here, people trade contracts based on the value of other assets, like options and futures. And the last one is commodity markets. These involve trading of raw materials like oil, gold, and agricultural goods. Next, let's quickly understand the difference between direct and indirect financial systems. In a direct financial system, borrowers and lenders deal with each other directly. For example, when a company sells shares or bonds straight to investors, that's direct financing. While in an indirect financial system, there's a middleman, like a bank or mutual fund. Banks gather deposits from savers and lend that money to borrowers. Similarly, mutual funds pull money from many investors to buy securities. Example of direct financial system, equity financing. Companies sell their shares, ownership, directly to investors to raise money. Example, buying stocks directly from a company. Debt financing. Companies borrow money by selling bonds directly to investors. Example, buying a bond where the company promises to pay you back later with interest. Direct means there's no middleman. The company talks straight to the investor. Example of indirect financial system, bank loans. Banks collect money from people's savings and lend it to others who need it. Example, you deposit money in a bank, and they use it to give someone else a loan in mutual funds. A company collects money from many investors, then buys stocks, bonds, etc. for them. Example, you invest in a mutual fund, and experts manage your money for you. I hope this helped you understand the basics more clearly. Thanks for watching.